Hello, today I'm going to do a quick video on the private equity industry. The GDP of the USA is $28 trillion, GDP of China 18 trillion, GDP of Germany is 5 trillion. The private equity industry in total manages $14 trillion of assets. Private equity manages funds on behalf of investors seeking returns in line with a certain risk profile. Ultimately, they're always trying to balance risk and reward. So how does it work? Well, a bunch of people get together and come up with a plan to invest in certain assets which they believe will create big returns. This is the PE firm. Let's call the leaders of the firm general partners or GPs. This is a GP. No, not a doctor, but one of the private equity team. The GPs find investors and try to convince them to part with their money to invest in a fund. This process is called a fundraise. Let's call the investors limited partners or LPs. This is an LP, a limited partner or investor, not a vinyl. The GP signs an agreement with the LP that sets out some key points. Key points could include how much the LP will commit to invest, what return the LP should expect, otherwise known as the hurdle rate, what types of investments the GP will make, and what the GP will actually earn. Let me explain the 2 in 20 model. GPs typically charge the LPs a fee of 2% of the funds they manage and then 20% of the return over the hurdle rate. If the GP gave the LP £250 million after 7 years, how much would the GP earn? Let's look at a scenario. Beaufort PE raises £100 million. It commits to achieve a 10% return over 7 years. The compounding we learnt about last time tells us that the GP would have to achieve a fund value of £195 million after 7 years. This is just 100 million times 1.1 to the power 7. That's £195 million. Let's assume the GP did a great job and actually returned £250 million after 7 years. What would this mean for them? Let's break it down. The annual management fee of 2% on 100 million equals 2 million per year. Carried interest equals 20% of 250, take away 195, which equals 11 million. So that's 14 million from the annual fee and 11 million from the carried interest. That's 25 million altogether. Just think about this. The annual management fee of £2 million a year is simply spent on office buildings, advisors and travel. Carried interest is what private equity is all about. It's the pot of gold at the end of the rainbow. Let me close with 3 key points. Private equity as an industry is bigger than many governments. Private equity firms invest other people's money and are strongly incentivized to perform. And finally, private equity firms can create significant wealth for themselves if they overdeliver for their investors. Thank you very much for listening.